Good evening. Can you hear me? Okay, good. So, um, mhm, okay. So now, yes, good evening. So now we are going to have, yes, good evening, everybody. Okay. So today we're having two lectures, and generally, as you know, we have two more lectures after this. And actually, the last lecture, lecture number 8, uh, will be about something which is not, which has nothing to do with the treasury bonds markets. It will be already the first topic for the second term. So that will be about stock markets. So we can say that there are 3 more lectures about the treasury bonds markets. So 2 lectures today and 1 more lecture next week. And with these 3 lectures, we are going to cover 2 topics only. And the one topic is the one which is really difficult, and I'm going to spend 2 lectures on it. So for this particular topic, it's about theoretical issues in the treasury bonds market. It's about pricing anomalies and arbitrage. So for this topic, I'm going to, I have reserved 2 lectures and then 1 more lecture for something which is a little bit more practical, something about immunization. So I'm not really sure how should I, so what should I do now? Should we spend these 2 lectures for this difficult topic, just one after the other? Or we should probably spend 1 lecture on immunization, which is quite different. And then we start this difficult topic and then wait for the next lecture to finish this topic, because it probably might be well, it could be another way, probably, to spread the difficulty over a period of time. So what do you think? Should we now complete this difficult topic for the whole evening, or should I start with the immunization and then switch to this topic? Because generally I'm quite indifferent and I have prepared 2 lecture slides for both versions. So what would you prefer? So hard topic, the one which involves abstract reasoning and metrics, mathematics. Okay, so I guess the rest do not mind. Okay, then let me now switch the demonstration of my screen so that you could see this this presentation. Okay, it's like that. So I remind you that for this topic you need to I ask you to refresh your knowledge of matrix algebra, because we are going to use it extensively in this topic. So now let me switch it on. Okay, so now also I will switch on the marker. Okay, so first of all, the topic which we are going to discuss for the whole evening today is also about consistent pricing and no arbitrage, just as it was in the previous lecture when we discussed discount function. However, when we discussed discount function, that was mostly practical. And recall that in the previous home assignments, we also discussed discount function. We actually built it using the strips prices from the UK Treasury bonds markets. And then we try to identify if there are pricing anomalies or there are no pricing anomalies. And recall that actually we found pricing anomalies, and all these pricing anomalies might point to arbitrage opportunities in case if transaction costs for strategies are not too high. Anyway, I have sent you this morning. I have sent you these home assignments, the solutions to these home assignments to your shared email, so you can well, you can browse through it, for example, or tomorrow or just over the weekends, and once again look at what kind of price anomalies we may get. And now we have the same topic about pricing anomalies, about no arbitrage, but now we look at it from a theoretical point of view. So we're going to build a very fundamental model, one of the most fundamental models in the whole theory of finance, not just only my course, but generally in financial science. First of all, let's move to the next slide. So what we have, pricing consistency. So recall we discussed pricing consistency last lecture, and this is, so we use this pricing consistency in order to price coupon bonds. So I will once again write down this formula for the coupon bonds pricing. So we have the price of the nth bonds, and we're going to use this first approach, a linear approach. That is the approach which is based on discount prices. So we sum up over all periods to maturity. We sum up all future payments. So these future payments include both coupon payments and the face value repayments. Therefore, I put subscript C here just to show that in different periods, these payments might be different. And well, I'm sorry, not this one, because this is not the yield-based approach. Okay. So, and then we discuss it using the discount price. So the price of a pure discount bond, which pays 1 in maturity. So if we assume that pricing is consistent, this is essentially amounts to saying that we get information from the discount bonds markets and employ this information, so discount prices, and employ this information to value a security in the coupon bonds markets. So we have this kind of connection between discount bonds markets and coupon bonds markets. If this connection is correct, if it is well, what we expect, then we can observe something like that in reality. If this is not like that, then we say that pricing is somehow inconsistent. So, or we can say that prices are not consistent. On we say that there is no consistent pricing. So whatever you put it, anyway. So that's what we observe. An example: assume that you, for example, see the following picture. So we have BN, a price of coupon bonds, and you compare this price to the its synthetic replication, which you can get from a discount bonds market. So in the discount bonds markets, you observe prices of strips for corresponding maturities, and then you combine all them together. You see that for somehow we see a difference value for the portfolio. So the coupon bonds price is different. For example, it is smaller than the value of its corresponding synthetic baskets. So this is definitely a kind of pricing anomalies, and assume that the this difference is so big that it cannot be rationally explained. So we cannot say that this is due to small liquidity, this is due to reinvestment risk premium or whatever. So it's really, well, too big to be rationally justified. So if it is not rationally justified, then we essentially have mispricing. So tell me, please, if you observe this picture that, if you observe the situation that the price of a coupon bonds is smaller than the value of its corresponding baskets of discount bonds. So what would you do as a trader? So you would just obviously just observe it, but actually you could implement something. So I know that someone has said something, but I just cannot access the chat window right now. For some reasons, it just doesn't work. Alt H, let me click on Alt H. Alt H. Okay, now it's it has appeared. So Zhao believes you'll take a long position in the coupon bonds, I guess. That's it? Nothing else? Just only buy these underpriced bonds. Well, ideally, you would like to hedge because otherwise that would be a purely speculative operation. That is a little bit more difficult, so we're going to discuss it right now. But first of all, assume that you're not a trader. Assume that you are actually a market maker who is the designated market maker who is allowed to strip securities. In this case, what would you do? So as you might know, any government markets of treasury bonds. Yeah, so I'm agreeing. So the generally the government's markets or markets for treasury bonds are markets which are made by or which are organized by market makers. So it's just on a rare occasion that you can privately trade in such markets, like in the Russian Federation you can. But the UK treasury bonds markets is organized by as a market maker markets. Therefore, market makers well, they give bid prices, they give ask prices, and actually some of them can trade not only just treasury securities, but they also has the right to strip securities into to strip coupon bonds into principal strips and coupon strips. But not all market makers, just a set of them, which are called designated market makers. So assumes that you are this designated market maker, you are allowed to take issue of treasury bonds and strip them into securities, into these discount bonds. And now you see this picture that the current bonds price is smaller than the corresponding value of strip securities. So what would you do? Yes, exactly. So that would be the best idea if you are a market maker and if you are allowed to do this. So if you are a designated market maker, then you would do this. This will be very fast, very quick, and for sure you would realize the profits, well, nearly immediately. So this is really good. However, you are not a market maker. After all, you're just simply a trader, probably even like not an institutional trader, but a retail trader. So in this case, as the previous two students said, they would take a long position in the coupon bonds. But then that will be just a risk operation because, okay, you take a long position and you wait probably that the price would go up because, well, because it should go up. But if you wait quite for a long period of time, assume that takes some time for the convergence, and over this period of time, a change in interest rates occurs. So, for example, you assume that the bond, you wait for the bond to go up, but then next day the general level of interest rates actually increases, and then your price go down simply because of this inverse relationship. So, as a response to an increase in interest rates, the bond's price go down. So it will not go up as you expect, but it will go down. So that is an example of a risk, and therefore, if you just buy a coupon bonds, you will you will have a speculative operation, you will have a speculative strategy. So as Zhao says, you need to add a hedge portion of the strategy to this operation so that it could be look like an arbitrage. So arbitrage operation, let me just write it's arbitrage. It always consists of two legs. The one leg is a purely speculative. So in this case, that's what drives your profits. Speculative part or speculative leg, actually it's called leg. Speculative leg of the operation. But if this is just only a speculative leg, then there's no arbitrage because essentially you are not safe. So additional leg is hedging. so hedge leg or hedging leg, in order to achieve a really arbitrage situation. So okay, speculative parts or speculative leg is to take a long position in the coupon bonds, and then what would you do else? So any ideas? How would you complete your arbitrage strategy? So you need to add hedging parts to the speculative parts in order to come to the arbitrage operation. So what would you do simultaneously with taking a long position in the coupon bonds? So recall that gold rule of arbitrage: buy what is underpriced and sell what is overpriced. So you buy a coupon bonds, then what do you sell? So you buy this, taking a long position in the coupon bonds. So buy. And then what do you need to short sell? Okay, short sell. Short sell. So Zhao, you said something about hedge. What did you mean? And by the way, I cannot again see this chat window. Somehow it disappears. I don't understand why. It doesn't work. So no ideas. Okay, let's look at this once again.
We
So
can
you
strips.
so say it once again, please.
We can short strips.
Right. Again, I cannot open any additional window, which is really weird. So, but anyway, that was the right answer. So if you if you take a long position in these parts, that is in the coupon bonds, then this is cheaper, the cheaper alternative. So you take a short position. Then this is more expensive alternative. So take a short sell, take a short position in this, short sell it. So let me just write it like that. Okay. And then you wait for convergence. Convergence of the prices, because after all, if these two versions, what we have to the left hand side and to the right hand side, if these two portfolios will give us identical cash flows, they must have the same price. So you wait for convergence, therefore you wait for the time when so let me just finish it. When the underpriced bonds would go up in price, and the the portfolio, which is probably overpriced because it's more expensive than the bonds, it will go down. So sometime later they will actually coincide in their value, and therefore you can get profits from the appreciation of your long position and from the depreciation of the value of the bond of the strips portfolio in your short position. So if it depreciates, then you can buy it back cheaper. Therefore, you realize profits both in case of the coupon bonds portfolio and in case of the corresponding baskets of baskets of strip securities. So that will be all fine. However, you might ask, where is hedge here? Because this is now just the case when when your profits is realized. So this is the parts when you when the speculative part is realized. So speculative leg is realized. So this one. However, why do you need hedging in this case? So at this particular example, this hedging does not seem to work because we don't need it. However, when will it be useful in this case? So can you tell me? Okay, I will probably give you one more hint. So when do we expect that the prices will converge? That is, the price of the coupon bonds will go up and the price of the corresponding baskets of strip securities would go down. It will occur if the market is something which we call a sideways. Well, in Russian, bokovik. So sideways markets, that is the markets which does not experience any trends, that is it just goes something like that. And well, it might be more or less volatile. It might be even nearly non-volatile, something like that. But anyway, in this case, indeed, if there are no trends in the markets, then we wait just for convergence. So tell me, please, and in this case, we don't need this hedging leg because these speculative parts will help us to realize profits. But then tell me, when do we need these hedging parts of the arbitrage strategy? So do we sell it? Do we short sell the baskets of strips just because, I don't know, because of nothing? Or we do pursue some objectives by doing this? Okay, let's assume that the market is not sideways. Let's assume that we have a directional market. So a directional market means that the market either goes up or goes down. So it depends on the direction. But anyway, we observe some direction. So prices either go up or go down. And you already know that in the bonds markets, in the treasury bonds markets, prices would go up if interest rate starts going down, and vice versa, prices go down if interest rates starts going up. So assume, for example, that interest rates. So you have taken a long position in the coupon bonds. You have short sold the baskets of strip securities, and then you just sit and wait for convergence of the prices. That's always fine. But then tomorrow, for example, unexpectedly, interest rates go up. The general level of interest rates goes up. And instead of, and your coupon bonds, instead of appreciating, just as you expected, depreciates. So what happens to, so you make a loss in your long position. But then what happens in the value of your short position? This one.
If interest rates go up, then strips, the value of it goes down, and
Right.
we were short selling it, therefore we make a profit.
Yeah, exactly. So you do have a loss in your long position, but the same response to a change in interest rate occurs for the portfolio of strip securities. So they also go down, but you have taken them, you have them in the short position, not in the long position. Therefore, in your short position, you actually realize a profit. Moreover, if you just buy one bond, for example, and the corresponding security of strip, a corresponding basket of strip securities in such a way that this basket corresponds to 1 coupon bonds, then this change will be 1 by 1 or 1 to 1. That is, the precise amount of money which you loses in your long position will be compensated by the same amount of money which you obtains in your short position. So you have minus here, but you have plus here. And then if these two values, the one which you loses and the one which you gains, are the same, then in general you come to 0. So what it means? It means the following. In the sideways markets, боковики, in the sideways markets, you wait for convergence, and if no trends occur, if no shocks to the markets occurs, then in the sideways markets you realizes positive profit. So let me call it usually as the letter P. So the profits will be positive. But then, and that's where your speculative leg of the arbitrage strategy works. But then, if suddenly a shock occurs to the markets, for example, a change in interest rates, then your gain in one of the position precisely outbalances the loss in the other your position, and then your profits is 0. So this hedging parts or hedging leg of the arbitrage strategy allows you not to have negative profits. So this is what's important. Do not believe that arbitrage is something which always gives you positive values. Not at all. You can have something like that. Profits can be either more than 0 or equal to 0. But anyway, the arbitrage strategy does not allow you to have negative profits. So this is what is important. So in a sideways markets, you have positive profits, and in case of directional markets, let me just write like that. In case of directional markets, you are hedged against any shocks to the prices, directional. So that's actually how the classical arbitrage works, directional. And that's what would you do if you observe such a situation that the coupon bonds is cheaper than the price of the corresponding the corresponding baskets of strip securities. That is, you wouldn't just have taken a long position in the coupon bonds, because this is not enough. You don't know if tomorrow there will be a change in interest rates or not. If not, that is fine. But what if it occurs actually? So you take a long position in the coupon bonds, and then you also take simultaneously a short position in the basket of strips, and then you might, and after this, you might say that you have secured a non-negative profit. So it will be either 0 or positive, but it will not be negative. So this is the classical example of arbitrage. So that's what would you do, or that is what you would do. And this is what would eliminate arbitrage opportunities immediately if many arbitrageurs do the same. So therefore, this activity of arbitrageurs, and actually in the treasury bonds markets, especially in those markets, in those countries where there is also a strip market, that is these arbitrage opportunities become very visible. So there are lots of arbitrageurs who actually watch the markets and try to compare prices and realize these arbitrage opportunities. So when they do the same actions altogether, then this just brings prices to some kind of equilibrium, and we can say that there is pricing consistency. So from this example, you already see that pricing consistency is the same as no arbitrage. So if we use this formula, if we do not see any anomalies when we use this formula, we essentially can say that there are no arbitrage, or we can say that, arbitrage opportunities do not exist. And this is the same as saying that the market has consistent pricing. Sometimes less formally, or very much informally, actually, we can say that there is no free lunch. There is no free lunch is the same as saying that there is no pricing consistency. So now I guess with all these explanations, you would all agree that pricing consistency is the same as no arbitrage and is the same as no free lunch. So, okay, you would agree with this. You would say that by intuition, this is all very understandable, but you will be surprised to know that actually this is not just something which you can derive from examples or from intuition. This is a theorem. Just like in mathematics, we have theorems, so we have several theorems in the theory of finance. And this is one of the theorems which just says that pricing consistency is equivalent to no arbitrage. Actually, I have put it here already, the name of this theorem. Let me erase something from here so that you could see this. So this is our theorem. It's called the equivalence theorem. Actually, it's called the basic equivalence theorem. So, and today, the whole 2 lectures will be spent on the proof of this equivalence theorem. So as any theorem, it can be proven, and that's what we are going to do today. We are going to prove this theorem. That is, we are going to prove that pricing consistency is the same as no arbitrage. Okay, let's now move to the next slide.
Sorry, can I ask a question, please?
Yeah, sure.
Why in some cases, like we have on the same time we have a short selling and we have long position, right?
Right.
So it seems to me that irrelevant of whether the interest rate will go, whether it will go up or down, we have profit in long position or or not profit, and we have minus on the other side of our situation. So because in order to make a profit, we have to, for example, have large movement in long position, or we have to have a large appreciation in the short selling position. How does happen? How does it happen?
So as far as I understand, your question is about whether our coupon bonds portfolio and our baskets would respond in the same way, in the same scale to the same change in interest rates.
Yes, because it seems that it always responds in the same way, but in order to make a profit, some side should be less in the in the values
Okay,
and
I understand you. So first of all, indeed, so assume that we have some shock to interest rates. So interest rates were like that, and then there will be a shock equal to delta y. That is, delta might be positive, might be negative. So either interest rates go up or down. And then the question is, do we have the same response from the coupon bonds portfolio? And from the corresponding basket of strip securities. So here we have strip securities with okay with well multiplied by this future payments. Well, in fact, first of all, the response will be absolutely identical, and in order to see this, you should recall something which is called duration. So we discussed duration some time ago, I think probably in the previous lecture. And recall that duration actually measures a change in the bonds with respect to a change in interest rates, so or with respect to this change. So this is the first order derivative. And then, so essentially, this is the question: if the modified duration for these coupon bonds will be equal to the modified duration for these baskets. If modified duration is the same, for example, I don't know, 4 or 5, doesn't matter, or 10. So then the response will be in the same scale. And actually, this is true. That is, I don't understand why I always have this, this sharp, I don't know, sharp triangles here. It's just really annoying. Okay. So anyway, these two modified durations will be the same simply because we can always represent modified duration of a coupon bonds as a weighted average as a weighted average modified duration of future cash flows. That is, modified duration of a coupon bonds is equal to the weighted average duration. So assume that we can separate different cash flows from the coupon bonds. Then we have modified, so this is weights 1 multiplied by discount bonds 1 plus weights 2 multiplied by discount bonds which matures 2 periods from now, okay, 2 periods from now, plus etc. And then weights C multiplied by discount bonds. So this is not discount bonds, actually this modified duration. Let me write it here. Okay, modified duration of the coupon of discount bonds which matures 1 period from now, then modified duration of discount bonds which matures 2 periods from now, and then finally modified duration of the discount bonds which matures 2 periods from now. And this is, if you look at this, this is actually our portfolio. So the and weights, what are weights here? Weights are cash flows. This is just as in any portfolio. In any portfolio, cash flows weights represents the value of the one particular security relative to the value of the whole portfolio. So essentially, you know, this relative to the current price, future payments relative to the current price. And then if we can represent the duration of the coupon bonds as a weighted average duration of individual discount bonds within this portfolio, then we can see that the response of this portfolio will be the same as the response to the coupon bonds. So they will react identically. Now the question is, what if you want to get profits even if the market is directional, and so you don't want to get zero in the directional markets. You would like to get profits. In this case, should you take a bigger position in the long position or a bigger value in the short position? Assume that your value in the bonds position is larger in this case than in the short position. So your long value, the value of your long position is larger than the value of your short position. In this case, the response, even though the response relative to one amount of money will be the same, but since the values are different in amounts of money, then the response will also be different. Okay, assume that interest rates go down. So interest rates go down. In this case, you actually have a profit in your long position because the value of your long position goes up, and then the value of your short position goes down. So here you have minus. And if the value of your long position is larger, then indeed, in this case, you actually realize profits even in the directional markets. But if it occurs only if you know for sure that the future interest rates will change in the downside direction. But you don't know this for future. What if interest rates instead of this go up? In this case, you have minus in your long position, you have plus in your short position, but your minus, your loss will be larger than your profits, your gain in the short position, because the original value of your long position is larger. The loss is larger also. So therefore, the classical arbitrage assumes that you take long and short position in such a way that the response to the shock will be the same. You'd better have zero in the directional markets, then you would have a small probability, even a small probability of the negative profits. So this is something like that. So did I answer your question?
Yes, I understand. Thank you.
Okay, so now let's move further. And now, we will start with the description of the bonds markets using linear algebra, or actually using just bonds, no, not bonds, oh my God, vectors and matrices. So let's assume actually everything which is given here, you already know this from the previous lectures, but now I just represent the same using matrix notation. So we have n coupon bonds in the government bonds markets, as usual, nothing new here. And therefore we have n coupon bonds prices. So as usual, we denote coupon bonds price with letter B, and therefore we have n coupon bonds prices, which can be arranged into a vector. So this is our row vector, and its dimension is, well, 1 by n. So that's how we count dimensions. So we have 1 by n dimension, and so this is our vector of coupon bonds prices. Now, as usual, we have T periods traded in the market. So there are T periods to the future. We do not make, so T capital is the final periods. We do not make any restrictions as to how long in the future we can go. We only require that T is a finite number, simply because if we have infinite numbers, then our model will just not work. It works only with finite numbers. So then let's consider one arbitrary chosen bond number n. And so this nth bond makes money payments. Again, I put subscript T here just to show that in different periods, these payments might be different. So for example, for all periods, it's just a coupon payments, but in the last periods, that will be the last coupon plus the face value repayments. And for sure, simply because we're talking about the treasury market, so these markets is non-defaultable. Okay, so all these payments which come from one coupon bonds number n, can be also arranged into a vector. So this is going to be a column vector, and its dimension is T by one column vector. So for those who don't remember, I use this sign. It's called prime sign, the prime sign, and this prime sign actually is used in order to show that this is a transpose of the vector. So we see now a row vector, but in fact this is a column vector. So actually you can use either prime sign or transpose, but I prefer to use prime sign. So this is going to be a column vector. And mind it that for all coupon bonds, so we have n coupon bonds in total in the markets, and for all coupon bonds, we can represent their future cash flows in the form of the column vector. It does not mean at all that all our coupon bonds are going to pay money forever, not forever, but to the last periods like that. Some coupon bonds may mature before the longest periods. This is quite obvious, but in this case, what we write, if we want to put numeric values into this vector, we will just write like zeros. So for example, somewhere in the middle, we will write 100. For example, this is the face value for the UK coupon bonds, and then we'll just write zero. So to the ends of the to the last periods, all the payments will be equal to zero. Why we do this? Because we would like to retain the same dimension for all column vectors. That is, for all coupon bonds, their column vectors, the column vectors of their future cash flows will have the same dimension, T by 1. Okay. So, and obviously we need to introduce our discounts prices because, well, we don't go further without them. So as usual, we have discounts prices. T means the number of periods which is left to maturity. And or in total, we have T discounts prices like that. And therefore, these discount prices can also be arranged into a vector. This time we have a row vector which has dimension 1 by T. So tell me, please, is it clear? Is everything clear? Whether everything is clear in these slides, or do you have any questions, or can we move to the next slide? Okay.
Why for coupon bonds and for discount prices we have row vector and not a column vector?
Well, in this particular representation, you can actually use whether columns vector or rows vector. Actually, that just doesn't make any difference at all. But later on, when we take these as inputs to the matrix equations, then it would be just necessary to reproduce them either as column vectors or row vectors. Because, for example, you know that we cannot post multiply a row vector. We cannot post multiply a matrix by a row vector. We can only post multiply by a column vector. Therefore, it's better to set them as a column vector or as a row vector initially and on this slides already.
Okay, thank you.
Okay, so let's move to the next slide. This is something which you also know. So this is our linear relationship between coupon bonds price and the discount bonds market. So this is our linear pricing formula. Actually, if we want to use matrix notation for this formula, then we can write it like that. So this is just the question why we for example, use discounts, average discounts prices as a row vector, but future payouts as a column vector, simply because this is how we can write this formula. And if we want to use condensed notation or brief notation, then we write it like that. Anyway, these three formulas represent the same relationship, just either in matrix form or in non-matrix form. And this is a relationship between discount prices and one particular coupon bonds. But we have n coupon bonds in our markets, and therefore we can actually take this equation, this one, and extend it in such a way as to incorporate all n relationship into this formula. So tell me please, so this is our basis, this formula is our basis. Tell me please, how do we need to slightly modify it to allow for n relationship, so that the formula, this matrix formula, which represents all n relationship between discount bonds and n coupon bonds prices. So, no ideas? Okay, then let's look at the equation itself. So what we do, we definitely extend this is a scalar, but we're going to extend it because we are going to have a relationship between n coupon bonds prices. Therefore, we extend it to the row vector of coupon bonds prices. The discounts vector, the vector of discounts prices remains the same. We don't change it. But as for the payouts, so here we have a payouts vector just for one coupon bonds, but then we extend it to the whole matrix, which represents payouts for different periods. So here, for example, we have one periods, here we have periods number t. So this payouts matrix represents different payouts for all coupon bonds which we have in our markets, observable in our markets, or traded in our markets. So coupon bonds, payouts from coupon bonds 1, payouts from coupon bonds n, so the last coupon bonds. So this matrix has its own name. It says its name is payoff matrix, and so remember it, because we're going to use this structure, which is a very important structure, by the way. And as for the vector of discounts prices, then actually it also has its own name. We call it discounts vector. So we don't say vector of discounts prices. This is too long. It takes too long time. So we just say discounts vector. And discount vector is actually well, I would say the very important parts when the whole market functions. That is, you might pay a really insignificant attention to this discount vector, but in fact, as you will see later on, it actually forms the backbone of the whole treasury coupon bonds markets in any country. So this discount vector. So this is like the basic elements of the whole treasury bonds markets. So let me just put it into the red box. Once again, this is very important structure. This is something without which the whole treasury bonds markets would not exist, in fact. So discount vector 1 by t dimension, and the payoff matrix has t by n dimensions. So here is t dimensions and dimension, and here we have n dimension. Again, if you want to express this in condensed form, then you use this relationship, which is given in the last line, so in this blue box. And this is our first consistency relationship. So let me just write it down. Okay. First consistency relationship. Okay, I will be brief. First consistency relationship. Why? So this is very important. In fact, in the future, when we build the model further on, we will encounter 2 more consistency relationships. In total, there are 3 consistency relationships, and this is the first one. So why it is important and why it is actually consistency? What kind of consistency we have here? We have here a connection between coupon bonds markets and discount bonds markets. So this is an attribute of the discount bonds markets, and this is an attribute of the coupon bonds markets. And this is actually the vector of prices, and this is also vector of prices. Therefore, we say that this is a price consistency relationship. So we have consistency, we have established consistency between prices in the discount bonds markets. So here ends the coupon bonds market. So price consistency relationship, or the first price consistency relationship. Okay, so everything should be clear here. And let's now move to the next slide. Now, let's assume that we create a portfolio from our coupon bonds. Obviously, any portfolio is described by its weights, the weights which we assign to each coupon bonds in our portfolio. First of all, let's denote the weights of coupon bonds using letter Z. So therefore, the weights of coupon bonds number N is denoted as ZN. And since we have N coupon bonds in our treasury bonds markets, then we have N weights. So these N weights can be obviously again arranged into a vector. And this time we have a column vector. Its dimension is N by 1 column vector. So now please be attentive here, because we in this model weights are interpreted not as as proportions. So you're accustomed to think that weights in the portfolio are just like proportions. For example, 20% weights of stock I don't know, 50% of stock J, and the rest amounts of percent goes for another security. So in this case, we measure weights as proportions, or as I don't know, as percentage in percentage terms. So in this model, weights are interpreted differently. Weights are number of units in which we hold each coupon bonds. In other words, this is simply the quantity. So for example, assume that Z1 is equal to 100. That means that you take a long position in 100 units of coupon bonds 1. So tell me please, what if Z1 is equal to minus 100? What does it mean?
Probably we took leverage.
Right. So leverage means that you take additional money to buy something, but in this particular case, it's just the other way. So when I buy something, I'm not sure whether it's possible to say leverage when we take short selling. Actually, in my opinion, leverage means that you take money from your broker in order to to take additional to increase your position, your loan position. So this is leverage. So that's what, for example, I have now in one very bad stock, which I'm really disappointed at.
I've just seen that people also use leverage for short selling.
Okay, I think in Russian we say marginalka, да, маржинальная торговля.
Yeah, probably. Mm-hmm.
Okay, so anyway, let's specify that in this case it's short selling, so you should sell 100 units of coupon bonds 1. And if that one is equal to 0, it means that you just don't hold coupon bonds 1 in your portfolio. So we would like to be as general as possible. Therefore, we just don't put any restrictions on Z. That is, Z can be positive, can be negative, can be 0. So this is a very general portfolio. Actually, it can be any portfolio we like, so no restrictions on its creation. So the question is, okay, you have constructed the portfolio using these weights. The question is, how much would you pay for this portfolio right now? So what will be the cost of this portfolio, or what will be the price of this portfolio? Well, price of this portfolio can be calculated in a very straightforward manner. So you take the price of each coupon bonds, you multiply by quantity of these coupon bonds, and then you sum up all together. and then you get the price. This is very straightforward. The same formula can be written using matrix notation like that. Or if you want to have a condensed notation, condensed or brief matrix notation, then you use something like that. So this seems to be quite straightforward. But then another question is, so you know that your portfolio has you have these weights for each coupon bonds in your portfolio. And then the question is, and you know how to calculate the price of the portfolio right now. But then the question is, how much would this portfolio give to you T periods from now? So assume that we have some periods in the future, I don't know, in 1 year, in 2 years, in 5 years. And then the question is how to calculate the amount of the payoff from the portfolio in periods C. So will you tell me? So this is really easy. So how do you calculate?
We can take future P and divide it by the current one, and it will give
Well,
us.
that would be return, right? But what's about payoff? Just the amount of money which you will get. Payoff means the Sampic and absolute values. So just the money which you will get in the future. So how generally do you calculate it?
Just subtract from the future P current one, right?
Well, no. Anyway, let me just show the formula. By the way, I have finally accessed this chat window. So let me just briefly see what do you write here. Increase rows and columns. Okay, I guess these were just answers to some previous questions. Unfortunately, this chat window was just inaccessible to me, so I can only have it right now. So I will try to have it somewhere here so that it would not disappear once again. Okay. And now let's me move back to the slides. I hope that this chatting window will not disappear. So the question is how to calculate the payoff from the portfolio. So you know the payoff from one coupon bonds. You know the weights of these coupon bonds. That is, therefore, you multiply payoff by the weight. So, for example, if you know that you will get 20, I don't know, dollars from one coupon bonds, and you know that you have 100 coupon bonds like that, then you simply multiply 20 by 100. That will be your total payoff from one coupon bonds. And then you do the same operation for all coupon bonds which you have in your portfolio, and then you sum up. So it's just like that. Okay, the window again disappeared. So if you, okay, now it's appeared again. So once again, you take payoff from coupon bond N, multiply by the number of coupon bonds which you have of these coupon bonds which you have in your portfolio, and then you sum up over all coupon bonds in your portfolio. Is that clear? So does it need any additional clarifications? Just say yes or no.
Excuse me. Should we use not Zn but Ztn, because there can be a situation when weights in our portfolio change, or we just assume that it is stable?
Well, in the future, you might rebalance your portfolio, but this is not the point of this topic, and this is not the point of this model, because we look at what happens right now. So we just look at what will occur in the future relative to the current points of time, current moments, and at these current moments we have just one static vector of weights, which does not, we just cannot change because we act now, right now. So anyway, principle. Yes, CTN. So as I said previously, again, CTN can include face value repayments. So if, for example, our coupon bonds matures in 2 years, then CYN will represent only coupons, but C2N will represent the last coupon plus the face value repayments. So in order to show that C might change from one period to another, I put this subscript C here. If I would remove this subscript, if I write something like that, then that would be a constant, right? This is constants, and this is not true because in the last periods we have a different amounts of money from our coupon bonds. Therefore, I write subscript C here just to show that this is not a constant. Okay. Okay. So anyway, you take payoff from each coupon bonds. You multiply this payoff by the amounts of coupon bonds which you have. For example, if you have 2 coupon bonds in your portfolio only, and if one coupon bonds will give you 50, for example, I don't know, 50 in 1 period from now, and the other coupon bonds will give you 10. And then if you have 10 coupon bonds number 1, then you multiply by 10. And if you have 5 coupon bonds number 2, then you multiply by 5. And then you sum up together. So this is our summation side. So you sum up over all bonds, and then that will be your payoff in periods T. In our case, this will be in 1 year. So payoff in periods 1. So like that. Okay, now, so this will be the payoff. This is how we calculate payoff for one particular period in the future. But as you know, we have T periods in the future. Therefore, in order to get payoff, a stream of payoffs from our portfolio over all periods, we have to calculate these sums. So here we have one sum only, but we have calculate T sums like that. And then these T sums can be arranged also as a vector. So let's arrange these T sums as a vector. So that's going to be our vector like that. So this is the payoff which we receive in periods 1. This is the payoff which we will receive in periods, in the last periods in our markets. And so we call this vector using, we use notation X for this vector. So X is the vector of future payoffs from our coupon bonds portfolio. So this is should be quite clear, but now there's a little bit less clear points which we need to clarify now. And this is about so do we have 13 minutes more? That's fine. So, and this is about, so let's look at this vector from a little bit different perspective. So it's first, if we look at it straightforwardly, we can say that this is this vector represents our future payouts from the coupon bonds portfolio. So payouts in periods 1, payouts in periods T. So this is just the payment stream from our portfolio. But then I will ask you another question. So tell me, please, if I would like to replicate the same payoff, just the same payoff as in case of our coupon bonds portfolio. So I would like to replicate the same payoff stream in the future using portfolio of discount bonds. So what kinds of portfolio of discount bonds should I create, and what should I be guided by? So, okay, once again, we have a coupon bonds portfolio. It's the weights. These are weights for this coupon bonds portfolio, and we know that this coupon bonds portfolio will give us this future payoffs in the future. But now I would like to have the same future payoff in the future, but at the same time, I would like to have discount bonds portfolio, not coupon bonds portfolio. So what should I do in order to create or replicate the same payoff in the future using discount bonds? tell me please if you are writing something, because I still cannot access this chat window. Oh, actually, now I can. Well, good guess, but not really. Okay, this is where abstract reasoning might help. And this is actually, by the way, this lecture is indeed for you to check whether you have good abstract reasoning or not. So see what happens. Right now you see only lectures and you don't understand how to answer this question. Let's now, instead of lectures, let's introduce some numbers. Let's assume that, for example, this sum, that is the amounts, the payoff from our coupon bonds portfolio, the payoff which comes in periods 1 is equal to 50 British pounds. And now I would like to have the same payoff in 1 period, 1 year from now, 50 British pounds. But I don't want to have a portfolio of coupon bonds. I want to have a portfolio of discount bonds. Tell me, please, so what kind of portfolio I should create? So what should be the weight of this portfolio? And I mean, what weight should I give to discount bonds, and what discount bonds I should actually buy?
Maybe it should be weighted by time to maturity.
Not sure. Okay. Once again, look. In the future, I know that 1 year from now I will get 50 British pounds from my coupon bonds portfolio. But I don't want to have coupon bonds portfolio. I want to get the same 50 pounds, but from discount bonds. Okay, pure discount bonds. Recall that pure discount bonds is the bonds which pays 1 at maturity. So what kind of portfolio should I create?
In theory, we can create a portfolio of strips of that coupon bond.
So
Because
what kind of strip do I need to buy?
of these exact coupon bonds that you have.
So the one which matures 1 year from now, right? Because this amount of money will be paid 1 year from now. So I need to buy a discount bonds or a strip which will mature 1 year from now, right?
Mm-hmm.
And so, and you know, that's one strip in theory. Again, we assume that pure discount bonds gives us 1 at maturity. So tell me please, how many such bonds do I need to buy if I want to get 50 instead of 1? So how many discount bonds do I need to put into my portfolio to get the same payoff?
$50.
Yes, 50, obviously. So, but okay, so I write here 50, but this time it will not be 50 British pounds, it will be a quantity. So I need to buy precisely 50 discount bonds in order to get the same payoff in the future in periods 1. And I can do the same for the rest of the period. So if, for example, this is some amount of money, I don't know, 100, for example, then I need to buy 100 pure discount bonds, which will mature T periods from now. So here I will buy 100. So do you see that it actually becomes much clearer when I operate with numbers rather than with letters? But this is actually shows that you still have a room to, well, how to say this, to develop your abstract reasoning. By the way, what is abstract reasoning in Russian? How do we translate it into Russian? Abstract reasoning. How do we say this in Russian?
Абстрактное мышление.
Yes, exactly. Абстрактное мышление, that is the ability to think something which you cannot really imagine, right? Like, for example, I don't know. Well, we will talk about this later because actually there will be more examples of abstract reasoning to check your abstract reasoning later on. So anyway, so what we can see, let's look once again at this vector. So this is our vector of future. So this one, okay, this one. So this is our vector of future payoff, and this actually represents the amounts of money which we will get each period in the future. But at the same time, this vector has another function. It shows us how many units of discount bonds we need to put into our portfolio to have the same payoff in the future. So, for example, as I said, well, as we have discussed it right now, if the first payoff is going to be equal to 50 British pounds, then I need to buy 50 pure discount bonds into my portfolio. So mind it that actually this quantity, this is a quantity obviously, so this quantity, this number of units of each bonds, in this model, we regard this as a weight because, for example, Z1, Z100, recall that that's what I previously said, is that these weights are considered to be numbers, not proportions in the portfolio, but numbers. So if Z1, Z2, Zn represents weights or quantities of coupon bonds which we have in our portfolio, then X1, X2, Xt will represent also a weights, but this will be weights not for a coupon bonds, but for a discount bonds. So essentially, we have two portfolios. One portfolio is described by these weights, and these weights are given to coupon bonds. And then we also have this portfolio, so this one, which is described by a vector of weights x1, x2, x3, xt, but these weights will represent quantities of discount bonds. So we have two portfolios, discount bonds portfolio, coupon bonds portfolio, and these two portfolios will give us identical payoffs. So the question only is, how do we ensure that these two portfolios will give us identical payoffs in the future? This is very simple. Take these future payoffs, the one which you can calculate right now because all data is given to you right now. Calculate each payment which is due in each period, and then regard this each payment as a number, as a quantity of discount bonds, and then you can create another portfolio of discount bonds, and this portfolio will give you the same payoff in the future. Actually, I call it zeros, so not discount bonds, but zeros. Sometimes in theory and among practitioners, the discount bonds are called zeros because they have zero coupons, so zeros. And therefore, this column vector represents weights for portfolio of zeros, for the portfolio of zero coupon bonds. So we have two portfolios. So this is our first portfolio of coupon bonds, and this is our second portfolio of discount bonds, and these two portfolios are equivalent in a sense that they will give us identical payoffs in the future. Now let me formally reproduce this, what I said. Okay, Zhao, so abstract reasoning. Yes, so that's what I said. Well, train your abstract reasoning. So this is just what I said. This is our portfolio of future payments. At the same time, we can look at this portfolio of future payments in order to understand what should be our weights of pure discount bonds in our portfolio. So like that. So these are weights of our discount bonds portfolio. At the same time, from this formula, so from this formula, so this formula can be actually represented using matrix notation like that. So this is the same formula. And now we have this connection. So this is a payoff matrix. Recall that this structure is called the payoff matrix. And this is the vector of weights for the coupon bonds portfolio. And now we have a connection again. So that's what is our aim. What our aim is to draw this connection between the coupon bonds markets and discount bonds markets. So this is attributes of the coupon bonds markets. This is the weights. These are the weights for our coupon bonds portfolio. And these are the weights for our discount bonds portfolio. And again, we have this connection, that is, we have weights for the, so holdings, actually, I write holdings here, but holdings is just that's what we say in English, like probably you have encountered this, portfolio holdings. Portfolio holdings means what assets you hold in your portfolio. So essentially, this vector represents the portfolio, the holdings of zero coupon bonds portfolio, and this vector represents the holdings of the coupon bonds portfolio. And we have connection between these two portfolios. If I put it in a condensed form, then I will have something like that. So this is our second consistency relationship. Recall that we already have one consistency relationship, this one. So this consistency relationship is price consistency relationship between we connect prices in the discount bonds markets and prices in the coupon bonds markets. But now we have the second consistency relationship, and this is going to be quantity consistency relationship, because we connect quantities in the discount bonds markets and quantities in the coupon bonds markets. So I think we can have a break right now, but tell me please if you have any questions regarding this or the previous slide. So if you have no questions, then we will make a break now for about 10 minutes, and then we will continue this topic. So I will, in this case, I need to stop, not to stop, to pause the demonstration now. So I suspend it like that. Okay, so and now let's have a break. Well, and in 10 minutes we'll meet again. Okay, so I think 10 minutes have passed and we can go on with the lecture. So let me now, so it's actually on the pause now, or should I press it like that? No, now I can go on with it like that. Okay, so we have finished with this slide. So as far as I understand, there are no questions regarding this slide, and therefore let's go further. So once again, let me switch on the marker. So once again, this is our second consistency relationship, quantity consistency. So, okay, let me just write it. Quantity consistency relationship. And then we have one more consistency relationship. And then we actually have one more consistency relationship, and that's gonna be derived in the next slide. So let's move to the next slide. Okay, so this is our first consistency relationship. It connects prices in the discount bonds markets and prices in the coupon bonds markets. Then this is our second consistency relationship, and this one connects quantities, so or weights or quantities. So these are weights in the coupon bonds markets, and these are weights in the discount bonds markets. And now we can derive one more important relationship. So for this, let's take the first consistency relationship. So this is our price consistency relationship. And then we post multiply the right-hand sides and the left-hand sides of this equation by the column vector of weights. So this is our column vector of weights. So we post multiply and then we get something like that. And then we already know that this combination is actually equal to the price of the portfolio. So we got it here. So recall that this is how we calculate the price of the portfolio. So therefore, we can just put a right price here. And then as for this relationship, then recall from this slide that payoff matrix post multiplied by the column vector weights well, is actually equal to X. So this is our column vector of future payoffs. So discount vector, which is given originally. So here we have this discount vector, and then we simply post multiply it by the column vector of future payoffs from our portfolio. Therefore, now we can connect the right hand side of this equation and the left hand side, and then we get something like that. So this is our third and the last consistency relationship. This is also the price consistency relationship because we are talking about price of a coupon bonds portfolio. And this is the discount vector, that is the vector of discount prices. So again, this is one more price consistency relationship, which connects the discount bonds markets and the coupon bonds markets. So what does this relationship say? It actually says that if we want to have the price of a coupon bonds portfolio, we can actually use two formulas. The first formula is this one. So we can use this formula, that is, in order to price a coupon bonds portfolio, we employ information from the coupon bonds markets, because these prices of coupon bonds, this is simply the information from the coupon bonds markets. Or we can do the other thing. In order to have the price of the same portfolio, we can actually use the information from the discount bonds markets. So we go to the discount bonds markets, we get necessary discounts prices, we post multiply by the vector of future payoff, and again we get price. So we can calculate the price of a coupon bonds portfolio either relying on the information from the coupon bonds markets or relying on the information from the discount bonds markets. And anyway, we get the same price. And one more important point here is that recall that when we calculate, when we compose a coupon bonds portfolio, so this is the price of our coupon bonds portfolio, this one. So the portfolio which has these weights for each coupon bonds. And recall that in this slide, I said that I do not attach any, I do not put or impose any restrictions on weights. That is, weights can be positive, negative, or zero. That is, this is essentially any portfolio which can be created in the coupon bonds markets. Therefore, bearing this in mind, I can say that this formula works for any kinds of portfolio, that is a portfolio which consists of 1 coupon bonds or 5 coupon bonds in short position and long position. And whatever coupon bonds portfolio we consider, we will always price this coupon bonds portfolio using the same sets of discounts prices. So once again, this relationship does not hold just for one particular portfolio. This result is absolutely and perfectly general. So for any kinds of coupon bonds portfolio, even if this portfolio consists of 1 coupon bonds only, we can always apply the same discount vector. So this discount vector is 1 for all coupon bonds portfolios. It does not change. It's just like, that's what I already said previously and even in the previous lectures, that discount vector is the backbone, the major elements, the basic elements of the treasury bonds markets. That is, it does not change whenever whatever coupon bonds portfolio would like to price. It's just the same sets of all discounts prices. Okay, so this is our first price consistency relationship. And now you can say, okay, we have established 3 price consistency relationships. We see now that we apply the same sets of discounts prices in order to price any coupon bonds portfolio. So this is our backbone. So what else do we need? In the sense that we already know that this discount prices is the backbone of our model of the whole treasury bonds markets. Isn't it enough? Well, unfortunately, this is not enough, because when we look at this discount vector, the vector of discount prices, we from these 3 formulas, we cannot make a conclusion whether this discount vector possesses necessary properties. What if not? So first of all, let's discuss what kinds of properties do we need from the discount vector, do we expect from the discount vector, and then you'll see why these 3 relationships just do not possess this, do not guarantee that these properties will be observed. So in order for you to understand this, I need to move to the next slide. So tell me please if you have any questions concerning this slide. Okay, looks like not. Okay, so I move to the next slide now. Okay, this relationship is the one which connects coupon bonds prices and discounts vector. So this is what we obtained previously. Actually, this is relationship, this first price relationship. Now it's just given in an extended matrix form. And so this is our discount vector. This is our backbone of the whole model. And therefore, we expect some properties from this discount vector. So what kinds of properties? I have formulated them in the slides. And essentially, we need to answer 2 questions. What if, so can we be sure that the discount vector is uniquely determined? And the second question is, what if discounts vector contains negative elements? So let's look at this, and actually let's first of all try to answer the second question because it's easier. I mean, it involves less discussion. So discount vector should be strictly positive. Let's assume that, and actually from these 3 relationships, there is no guarantee that the discount vector will contain only non-negative elements. And let's assume that for some weird reasons, we have negative discount prices. So what would it mean? Can you tell me? Just imagine that you obtain negative discount vector, or at least some elements of this vector are negative. So some discount prices are negative. So can you imagine this? And what would this mean? Okay, first of all, tell me please, can you imagine a negative discount price? Or just, can you imagine a negative price? So you are silent, but however, I would like just to see your opinion. Is it possible to have a negative price for something? Negative price for a security in our case. So you believe that this is going to be positive because all other all wait for a second because okay, I guess I need to take a cup of water. Wait for a second and take this time to think what will happen if the price is negative. Okay. Can I talk now? Yeah, I guess I can talk. So, Zhao, you assume that D will be positive simply because all other elements are positive. Actually not. Recall that in our, well, how to say this? Because all elements are positive. I'm not sure that this actually comes from the fact that all elements of this equation are positive. No, not at all. It doesn't come from this fact. I don't think so. No. So let's talk about the negative price. If the market interest rates are negative, then, well, no, the price actually will be positive. The gross return will be negative. Not only the net return will be negative, but as Friday said, the gross return will be also negative. But
I think that maybe in order to have negative discount price, we need to have a really big negative yield, like more than -1, more than -100%. Only in that case it's possible. If we consider discount price as 1 divided by 1 plus y in power of t, right? So we need to have a really big negative yield.
well, okay. Well, actually, that might sounds reasonable. But what I mean, okay, let's assume, Ilya, so assume that you sell a security to, you're a trader and you sell a security to another trader. Assume that this trader is a very beautiful girl and she says something like, you know what, I'll buy the security, could you please give me a little bit more money in addition to the security? and assume that you are allured by this girl and you give this money. So this is an example of a negative price. You actually are supposed to receive money instead of the security, but you actually give away money. So when the price is positive, if, for example, I'm a buyer of the security, if the price is positive, I have to pay money, so I give away money. If the price is negative, let's just switch on logic. I receive money instead of giving away money. So I have a security and I have money itself. So this is an example of a negative price. So that might occur probably in theory, but later on I will give an example when the price actually can be negative indeed. But now this is just for you to understand that the price can be negative and what does it mean from the point of view of the payment stream. So you, as a seller, you give away money instead of receiving money, you give away money. That will be an example of a negative price. Now, so can we say that a negative price is an example of an arbitrage opportunity? So if you, well, assume that you somehow see that the price is negative, what would you do? You would definitely buy the security, because in this case you would have a security and money. But ideally, under normal conditions, you're not supposed to have both the security and money. You either have security or money. So if you have both the security and money, then you exercise this arbitrage opportunity. So negative price would definitely point out to arbitrage opportunities. As I said, I will give an example of a negative price, real negative price, in the next slide, or probably in a couple of slides. But now this is just for you to understand. Okay, let's move to the first question. Discount per vector is uniquely determined. So so where does it disappear? So we have it. Okay. Okay, like that. So so the discount vector is uniquely determined. Once again, can we actually say that we will get only one solution to this equation? In order for you to better understand this, I transformed this solution to the system of linear equations like that. This is something which you are more familiar with, because this is just something which you all studied at school. So we have a system of linear equations, and we have t unknown variables. So this is our t unknown variables, and we have n linear equations. So linear equation 1, linear equation 2, etc., and then linear equation n. So and then here we have a question. How can we be sure that the discount vector is uniquely determined? And what happens if it's not uniquely determined? In order to answer this question, let's look at this system of linear equations once again. And actually, let's consider 3 cases. And now I guess you need to recall something from mathematics exactly about this system of linear equations. So assume that t.
Sorry, can I have a question? Ask, what do you mean by uniquely determined? Like it's.
Ну, in Russian все однозначно определенный.
Да. Понял.
Или непонятно? Понятно.
Нет, не уверен, что понятно.
So meaning that there's only one version of this vector. There are no other versions, uniquely determined.
Okay, thank you.
Okay. So let's assume that we encounter the case when n is more than c. That is, the number of linear equations is larger than the number of unknowns. So tell me, please, how do we call this system in mathematics? So recall school mathematics, and the number of linear equations is larger than the number of unknown variables, and such system is called as. So Zhao, tell me, please, do you study something like that at school in China? I just wonder, in a sense, that whether we have similar mathematics.
No, because metric is is studied in university. We don't learn metric in high school.
That's interesting. When I studied at school, I actually studied matrices. I hope that current school children also study it. So, any versions how we call it? Okay, this is actually called this system of linear equations is called overdeterminants. I think in Russian we also say just переопределенные. Overdeterminants. So now my question to you is, so this is how we call it in mathematics, an overdetermined system. Number of equations is larger than number of unknowns. But if we switch to finance, tell me please, what kinds of, so does it remind you something? Essentially in finance, we have something like that. Number of bonds is, okay, number of bonds is larger than number of periods which are given to us in the future. So does it remind you something from the points of view from the previous lecture about discount function when we discussed term structure, coupon term structure and discount term structure? So recall about term structure. So recall complete term structure, incomplete term structure, and what would you say if we just move from mathematics to finance? So what can we say from the point of view of the term structure? So, okay, tell me at least what kinds of term structures do you remember from the previous lecture? So there are two versions only, either complete or incomplete. And if we look at this situation, that the number of coupon bonds traded in the market is larger than the number of periods available in the future, then what kind of structure is that?
If you have more, then it is complete structure.
Okay, so Zhao also believes that this is complete. Well, in fact, so recall that in the case of a complete coupon term structure, we have a coupon bonds, one coupon bonds maturing, precisely one coupon bonds maturing each period, that is each time when the coupon payments is done. So, or it is made, actually, right, is made. So precisely one. If it's less than one, then we have incomplete term structure, but actually in our case, it's not just one coupon bonds that matures, but actually on some occasions, in some periods, we have more than one coupon bonds which matures. Actually, this is called, well, I did not tell you this about this last time, but this term structure is called more than complete term structure. So in some periods, probably not on all the periods, but in some periods, we have more than one coupon bonds which matures in that period. Well, this is something very, very much theoretical, except for the USA, because actually in the USA, over certain maturities, the term structure is indeed more than complete. Well, okay, now, so let's switch to mathematics once again. So in mathematics, we have overdetermined linear system of linear equations. And now the most important question, how many solutions does such system have? So do you remember? So let me write here more than complete. So for those of you who do not understand, so more than complete. Complete. Well, so will you answer this question? How many solutions does the overdetermined system have? Any guess? So it seems that you have studied mathematics very, very long time ago. Okay, tell me please, how many versions generally can we have? So what kind of versions or what kind of, okay, versions, right? So what kind of versions of answer can we have? Actually, we can have only 3 versions of the answer. Either no solution or one solution or infinitely many solutions. And in this particular case, when we have overdetermined system which cannot be degenerated further, that is, it stays overdetermined, we are bound to come to a null solution. So this kind of systems have no solution. So okay, no solution means that we do not have a discount vector. So discount vector just cannot be derived from this. No discount vector can be derived from this system of linear equations. Let's move from mathematics to the financial markets once again, to the treasury bonds markets. So in this kinds of situation, we do not have a discount vector. No solution means no discount vector. So tell me please, what does this mean? What does it imply for the treasury bonds markets? So try to imagine that there is no discount vector. Then there is no discount bonds markets. Okay, and is there a coupon bonds markets? So what does it apply for the coupon bonds market? Because this is our most important part, what we actually consider the coupon bonds markets. So what would happen to the coupon bonds markets if there is no discount vector? Well, this is right. We cannot obtain prices for coupon bonds, in the sense that we don't have this, how to say this, we would not have this guides as to how to price. That is, we don't have this backbone, we don't have something which we make reference to in order to price coupon bonds. So essentially, these kinds of markets where the discount vector does not exist, these kinds of markets does not exist either. At least it cannot exist for a long period of time, because this market is very unstable. In absence of discounts, the discount vector, then the system goes out of the equilibrium. And as you know, probably the system which is out of the equilibrium cannot hold for a long period of time, at least, or unless it is maintained in this condition artificially. Otherwise, it just crashes. So, or crashes, no, crashes, I think. I always confuse these two verbs, to crash and to crash, but I guess it should be crash. So in this case, the markets, the coupon bonds markets would just crash, and it would crash always until this discount vector would appear. So as that picture, I should say, so therefore somehow we need to have the discount price vector. Okay, now let's assume that the other case, that n is less than t, so number of linear equations is less than the number of future periods. In this case, is less than actually the number of unknown variables. So in this case, the system is actually called underdetermined. So not overdetermined, but underdetermined. And again, in Russia, one of the versions is недоопределенная. However, there must be some other versions of translation. So underdetermined system. And now tell me, please, how many solutions does the underdetermined system have? So try to guess.
Sorry, could you repeat the question?
So the question is that if we have the underdetermined system, when we have number of linear equations less than number of unknown variables, how many solutions do we have to this system?
Sorry, can I ask a question? What does T mean? Is it payments of discount bonds? Is it connected to term structure of?
Yes, so this is the number of periods in the future. So T is like we state T is equal to 1 period in the future, 2 periods in the future, etc. And we end with the longest periods in the future, which is T capital.
Okay. Is underdetermined is the same as incomplete?
Yes, from the point of view, if we switch to mathematics to finance, indeed, in this case, we have incomplete coupon term structure, and therefore, okay, and then coming back to the, well, to the mathematics. So what will you tell me about the number of solutions for this kind of system?
I don't know. Sorry.
Okay, again, in this case, if the system is incomplete, we might have either no solutions, so there are two versions, either no solutions, and this we already have discussed, or the infinite number of solutions, that is infinitudes of solutions. So let's discuss this version. We have infinitudes of discount vectors, so infinite versions of this discount vector. So what's, again, let's move back to the finance and to the treasury bonds markets. What will happen to the coupon bonds markets if we have an infinite number of versions of the discount vector?
Then we have infinite version of bond price.
Well, looks like that. Is it good?
Not good.
Well, this is actually pretty bad, because in this case, the markets will be completely, will lose its orientation, because in this case, there will be no guidance as to what vector should be considered to be the right one to have fair prices. So therefore, the markets will go out of the equilibrium, and again, it will crash. So it seems that if T is more than N, and if N is less than T, then we always have a market which crashes, which is not really good. So ideally, we would like to have a unique solution for the discount price vector. Therefore, we would like to have one version of the discounts of the sets of discounts prices, because only in this case we'll have a precise reference to the discount bonds markets if we want to price a security in the coupon bonds markets. So therefore, that's what we want. We want a uniquely determined discounts vector, and we would like to avoid infinitely many solutions or no solutions. And also we would like to have positive discount vector, otherwise we would encounter arbitrage. So what to do actually? The question is, how can we show that the discount vector is just indeed positive and uniquely determined? Because once again, from these three equations, it just does not follow this. So in order to show that, in order to consider these cases, let me, by the way, okay. So in order to consider these cases, in order to answer these two questions, we need to build this model of the treasury bonds markets. And actually, we are going to discuss this model in two versions: general model and a special case. Now, this is pretty much straightforward, so probably you have already encountered many times that a general model is built, and then there is a special case for this general model. But we will start with the special case because it's really very easy, and then we switch to the general model. So now I move to the next slide, and this is our general case. So the general case actually just calls the model of a complete bonds markets, and now you will probably understand why we call it a special case. So complete bonds markets. Recall that in a complete bonds markets, a coupon bonds for each period we have one coupon bonds which matures. So precisely one, no less than one and no more than one. So this is a complete coupon bonds markets model. And then this actually corresponds to the situation when the number of linear equations is equal to the number of unknown variables. That is, the number of coupon bonds is equal to the number of periods which are left in the future. So in this case, each bonds matures in each period. So therefore, okay, I'll go to the slides. So therefore, we have complete coupon term structure, and let's now discuss these kinds of markets, which is complete. So we have a complete bonds markets. As usual, in these markets, we have n government bonds. Now we have payoff matrix, which is not an identity matrix, and we have number of coupon bonds, which is equal to the number of periods left in the future. So this is our complete coupon bonds markets. So what implication do we have from this? We have one very important implication. If n is equal to t, then our payoff matrix, this one, is actually a square matrix. And a square matrix, as you might know, is invertible. So we can get the inverse of the square of this payoff matrix. So essentially we can get like that. So this is the inverse of the payoff matrix. Okay, so now what we can do with this? Let's take this equation, and I remind you that this is one of our consistency relationships. So this is this consistency relationship, quantity consistency. So we take this relationship, and what we do, let's post multiply the right-hand side and the left-hand side of this equation by the inverse of the payoff matrix. So somehow it's okay. Okay, actually, we will postpone this multiplication because this is, well, I is identity matrix. So do you know what is an identity matrix? It's like that. 1. So we have 1 over along the main diagonal, and we have 0 otherwise. So tell me, please, if we have this kinds of payoff matrix, what kind of markets is that? So here we also have 0. So you get 1 in each period, right? So, and that's it, and no in all other periods. So this looks like not really complete. Actually, well, it is complete, but it's a discount bonds market. Do you agree with this? That in each period you get precisely one. So this is a discount bonds market, and that's why I put it. I put it, well, this, I don't know, non-equality or disequality sign, just to say that we're talking about the coupon bonds markets, not the discount bonds markets. Therefore, I require that this is not equal to the identity matrix. Well, because if it were a coupon bonds markets, then you would get payoffs in different periods. So for example, assume that this is bonds 1. So here we have bonds 1, and this is bonds 2, for example. So if this is a coupon bonds, then it will pay you difference. It will not only pay you the face value, which is equal to 1. It would pay you also coupons. But in this, it seems that it only gives you the face value. It does not give you any coupons. Or look at the coupon bonds 2. It gives you only one payment, which is equal to 1. And it does not seem to give you any more payments. Again, this just does not look like a coupon bonds. It's actually a pure discount bonds, which will give you 1 at maturity, and it does not give you any other payments meanwhile. So this looks like a structure. This identity matrix looks like a structure for the discounts markets. Anyway, we don't look this relationship. I don't know why it appears here. Actually, you can use it, but not in this slide. With this consistency relationship, and what we are going now to do, since we can obtain the inverse of the matrix, let's multiply the right-hand side and the left-hand side by this inverse matrix. So if we do this, we will get something like that. And so I rearrange terms now, and then what we have? We have this discount vector, and what we can say about it? First of all, wow, great, it exists. And it exists because we can always get the solution to this equation, So we just need to inverse, to get the inverse matrix. We can always get the solution to this equation because our matrix is invertible. So if it is invertible, then we can get a solution. So the discount vector exists. But another more important property is that this discount vector is actually uniquely determined. Why so? Because we have a complete bonds markets which corresponds to the case when n is equal to t. This case in mathematics is called a balanced system. A number of linear equations is equal to number of unknown variables. In this case, if I ask you the question, how many solutions does a balanced system have, then the answer is 1, only one solution. So a good thing about our complete markets is that we have balanced system. So n is equal to t. We have balanced system, and therefore we can get only one solution. So the solution exists, and the solution is uniquely determined. Therefore, we get this discount vector. And this is the answer to our question, whether it's uniquely determined. Well, for the complete bonds markets, it indeed is uniquely determined. And this is really great. However, the problem is that if we try to answer another question, that if the discount price vector is positive, then unfortunately this market does not help us to answer this. So therefore, we need to switch to the complete general, not to the complete, but to the general coupon bonds markets model, which is a little bit more complicated. So let's move to the next slide. It's I will miss this because this is something which is not really essential right now. Okay. So in order to discuss this problem about negative discount prices and whether the discount vector is uniquely determined, first of all, let's give us a formal definition of arbitrage and a formal definition of pricing consistency. So the definition of price consistency is that we have this relationship, well, the one which we just discussed here. So this is our price consistency relationship. And then we require that this discount vector exists and that it is positive. So this is actually our price consistency. I write its date price vector here because it's another name for the discounts vector, but actually, in order for you not to be confused, discounts vector. So this is discount vector. So essentially, price consistency means that we do find this discount vector in our treasury coupon bonds markets, and this discount vector, it exists and it contains only positive elements. So if this is so, then we can say that the market is consistent, or the pricing is consistent. But now let's look at the arbitrage. So definition of arbitrage. We can create a portfolio. So let's call this portfolio F. So I can create a portfolio in such a way that this portfolio would satisfy either this system of inequalities or this system of inequalities. And now let's discuss what kind of inequalities are these. So let's start. Well, they're actually pretty much similar. You can see that the difference is only in these signs. So here we have strictly less than, here we have less or equal to, less than or equal to. And here we have more than or equal to, and here we have more. So essentially, the difference is not really critical. So first of all, let's just discuss what we have here. So recall that this is the price of our portfolio, the one which the portfolio of coupon bonds prices, the portfolio of coupon bonds, which we can create using this vector of weight. So these are our vector. This is our vector of weights for the coupon bonds portfolio. This is a row vector of prices for the coupon bonds, and then when we multiply them, then we get the price of the whole portfolio. So essentially, what's our portfolio? If this is an arbitrage portfolio, then we should observe the following. The price of this portfolio is negative, and X is our future payoff. So recall that we discussed X here at the very beginning of the first lecture. So recall that this is actually our future payoff. So X is our future payoff from the coupon bonds portfolio. So that's how we calculate our future payment stream. And then it's now arranged in a chronological order from the first periods to the last periods in the future. So this is our payoff, and recall that we calculate this payoff by taking the payoff matrix and post-multiplying by vector of z, so like that. So just take this in, so bear this in mind, because I now move to our current slides. Okay, this one. Okay, so this is our future payoff. So we would like to have a portfolio which has negative price right now, but in the future it will give us positive payoff. Positive payoff, or at worst, it will give us zero payoff. So tell me, please, what do you think of this portfolio? So the portfolio has negative price right now. Okay, first of all, let's discuss this negative price once again. It's really difficult to imagine a negative price for the security. I mean, if I would see a negative price for a security, I would immediately buy this security, because in this case, I would get the security and the money itself. But I guess this is too obvious, and then that's why negative price just does not exist. Well, X is the number of discount bonds, but however, recall that X can be has dual function. On one hand, X can be considered as a weight for the discount bonds portfolio, but at the same time, X represents our future payoff for our coupon bonds portfolio. So right now we look at this vector as a vector of future payouts. So we don't consider this as a weight for the discount bonds portfolio, because we're only talking about the coupon bonds portfolio. So we look at it from the first points of view. So as I said, it's highly unlikely that you will encounter a security with a discount price, but is it possible to have a portfolio with a discount price? So a single security with a discount price is highly unlikely to be met. But as for the portfolio, which has a discount, which has a negative price, did I say discount? But actually should be negative. So a portfolio with a negative price is quite a possible thing. Actually, it's quite a common thing that portfolio has a negative price. So for you to understand this, so once again, a negative price is when you form a portfolio. When you buy a portfolio, is the same as you form a portfolio. So you form a portfolio, and if this portfolio has a positive price, then you actually pay money. But if the portfolio has negative price, you actually receive. So you form a portfolio, you have a portfolio, and you have money. So tell me, please, is it possible to have a portfolio and to have money at the same time? Oh, are you sure? Well, actually, I have this portfolio right now with my broker.
I have a question. If I have a portfolio, the P is negative, does that mean I'm losing money?
Well, okay, so I will explain to you how is it possible to have a portfolio with a negative price. So assume that I have in my portfolio long and short positions, and assume that the value of my short position, well, it's approximately, okay, I will not give you my real values. Let's just use some imaginary values. So assume that's my the value of my short positions. So do I short, what security did I short actually? NLMK, by the way. So okay, so assume that the value of my short position is equal to 100,000 rubles, right? So I should sell and I give 1,000. Okay, I will just write 1,000. And then I have short position in my portfolio. And then I use this money to finance my long position, but I use only 50,000 to finance my long position. 50,000. So if we look at this portfolio, the value of my short position exceeds the value of my long position. So I don't spend my own money at all, right? So I have this 100,000. So I have short position in my portfolio, I have long position in my portfolio, but then additionally, so these are some stocks, these are also some stocks, but then additionally, I have in my portfolio 50,000 rubles, which I do not use, just cash. So now I have formed a portfolio. I essentially, I have bought a portfolio, I have formed a portfolio, but then additionally, I have some money left. So this is an example of the negative price. So I have a portfolio with a negative price. As you can see, having a portfolio with negative price is not really a big deal. Anyone can form a portfolio with a negative price. So this condition, this one, it can be easily observed. So I don't have any problems in creating the portfolio which satisfies this condition. But that's not the arbitrage portfolio yet. If I manage to create a portfolio which satisfies also this additional inequality, then that will be an arbitrage portfolio. If not, then this is not an arbitrage portfolio. This is simply a portfolio with a negative price. So what we have here, negative price for the portfolio. So as I have created a portfolio and I receive money right now, but then if also in the future I will receive money from this portfolio, then that will be an arbitrage portfolio because I receive money right now, I receive money in the future. It seems that I receive money in all periods for which my portfolio is active. This is too good to be true, and this is definitely a situation with an arbitrage opportunities. So it's how to say this? I do not. I will not pay in the future for the money which I receive now. This is just this is something which contradicts economic reasoning. If you get money right now, you have to pay for it in the future. But it seems to me that I do not. Now, if you look at this version, then I can, for example, form a portfolio for a zero price. In this case, my short position value should be equal to my long position value. In this case, I spent 100 for the long position, and then I'm left with 0 rubles. In this case, this situation works. So my cost of the portfolio is equal to 0, not negative, but 0. But then if at the same time I manage to create the portfolio in such a way that in the future I will get only strictly positive cash flow, then again that will be an arbitrage, because I do not pay right now for the money which I will get in the future. Again, this is not compatible with economic reasoning. If you want to have something in the future, you need to pay for it right now. So in both of these cases, this is an example of arbitrage portfolios if either this case holds or this case holds. So is it clear to you? Okay, let me check if it is clear to you. I will just move to the next slide. And here we have a kind of illustration. So we have 3D representation, and what we have, assume that we have a 2 periods world. That is, in the future we have only 2 periods. Periods 1, for example, 1 year from now, and period 2, 2 years from now. So we do not have any more periods in the future, because for this we would need to have additional axes here, but we only have 3 axes, so we just cannot increase the number of periods in the future. So this horizontal axis represents periods, cash flow received in periods 1. This axis represents cash flow received in periods 2, and this axis, the vertical one, represents cash flow received or given away right now. Well, right now is moments of time equal to 0. So right now we have okay, t is equal to 0, so that's what I write here. So what do I mean NPV? But the present value. So if you mean cash flow right now, then it's actually better to say present value, not net present value, just present value, the price. So now we have t is equal to 0. So this is what we reserve for the current moments of time. So and this is cash flow received now, and these 2 horizontal cash flows are money which are received, represents money which is received in the future, in periods 1 and in period 2. Means is that this is not the price, but this is the balance of the price. What is the balance? The balance is what is left. So if the price is positive, as it usually occurs, if the price is positive, then the balance is negative. You give away money, you are left with negative amounts of money. But if for some weird reasons the price is negative, then you actually receive money and the balance is positive. So therefore, obviously this axis represents the positive parts of the balance. So this positive parts means that the balance is positive, and therefore these parts of the axis represents negative price. So negative price, positive balance. So you don't give away money, you receive money. And now let's assume that this point A, represents one particular portfolio. And now we can describe this portfolio from the point of view of its cash flows. Cash flows now, cash flows in the future, and cash flows cash flows in 1 year and cash flows in 2 years. So what would you say about cash flows for this portfolio? Are they negative, positive, or whatever? So how would you describe this portfolio? So can you try? So this portfolio should be described from the point of view of its future cash flows. It has some cash flow right now and in the future. So how would you say what cash flows are associated with this portfolio, points A. By the way, it is located on the axis. Again, recall from mathematics, what does it mean? That the portfolio is when the point is located on an axis. Okay, Ilya, can you try?
Maybe in point A we have cash C0. I don't know.
So recall from mathematics, when the point lies on an axis, how can it be described? So with what kind of coordinates, mathematical coordinates? So what's about its cash flows in the future? So this is the first cash flow and this is the second cash flow. So are they, well, how to say this? Do we actually get anything in the future if the portfolio lies on the vertical axis? So you actually could describe it from the points of view of three points, right? These points, so which corresponds to each axis. So like three numbers here. So what's about, for example, these two horizontal lines?
Horizontal lines they equal to 0.
Yes, right. So we will write 0 here, 0. The second coordinates will be 0, and here, I don't know, just some number. I don't know how to.
A.
Well, A is the name of the portfolio, so, and it's not the number, it's the name of the portfolio. But actually, so let's call it like that. That will be some cash flow for the portfolio A, right? It's like that, so that's probably better. So you'll get 0 in periods 1, you'll get 0 in periods 2, but this is positive part, so you'll get some positive amounts of money, positive cash flow right now. So can we say that this is an arbitrage portfolio? So you get some positive amounts of money right now, but you don't, and the same time you don't get any amounts of money in the future, but you don't pay any amounts in the future. You just have money right now. No arbitrage. So once again, you have money right now, just for nothing. You won't pay for it in the future. There will be no negative cash flow, no cash outflow from you in the future. So you just get some money right now for nothing.
I think it's arbitrage because I got money right now and I don't pay anything.
Exactly. So you get money right now, you don't pay for it in the future. This is an arbitrage portfolio. Let's look at portfolio B and tell me, please, how would you describe this portfolio from the points of view, again, from the points of view of current cash flows and future cash flows? So, Zhao, can you try?
Sorry, can you explain please why at point A we have arbitrage? As I understand, arbitrage is when we have price inconsistency and we buy something for lower and for low price and sell it for the higher price in someone in a different market. But
this is something which is a very primitive definition of arbitrage. You know, like you have the same security, you observe it in two different markets, and then you see whether their prices are different or not. This is something, well, I would, if I teach a first year students, not master, but the bachelor first year students, I would describe arbitrage like that. But this is not the level of the level of master's education that I would describe arbitrage like that. You need to be more general in understanding arbitrage. Arbitrage is something, arbitrage is free lunch. Like recall what I said in the very first slides. This is a free lunch. So think of this in the most general way. If you get money right now and you don't need to pay for it in the future, this is free lunch for you. Do you agree with this?
Yes.
So this is arbitrage, and not just, you go to the markets and compare it to the prices for the same security in two markets. This is, well, this is a very primitive definition.
Okay, understand. Thank you.
So Zhao, can you try to explain portfolio B from the points of view of cash flows?
Mm,
So it's like that, like
it's
that.
like I pay money out. I pay money back at X1B and X2B, but
So do you pay it or you receive it? I just did not hear.
I receive.
Right. So you receive
But
the amounts of money.
but I get nothing at this moment.
So essentially, you do not pay for it right now. So your current cash flow, cash inflow, or cash outflow is equal to 0. So we're at this point, so it's 0. So essentially, you somehow arrange your portfolio in such a way that you don't pay for it right now, but in the future, you will get this cash flow in period 1 and this cash flow in period 2. So is it an arbitrage portfolio?
Yes, I think.
Yes, this is an arbitrage portfolio because once again, you don't pay anything right now for something which you will have in the future. So you for in the future, for sure, you will get positive amounts of money, positive cash flow. Right now, you would have supposed to pay for it, but you do not. So somehow you manage to create a portfolio in such a way that it costs you nothing today, but in the future, this portfolio will give you positive cash flows. So again, this is a portfolio which we call arbitrage portfolio. And now this last point D. So can some of you describe this portfolio from the points of view of future cash flows? So this one.
So at this moment, I get cash flow at D point, and in the future, I also receive cash flow at X1B and X2B.
Yeah, this is correct. So okay, probably anyway, I guess you can just visually draw this line and see that somehow you will get positive cash flow in the future in periods 1, in periods 2, but at the same time, right now, this portfolio also gives you a positive amount of money. Therefore, this portfolio has negative price, and while it has negative price, you have positive amounts of money. So which portfolio is the best one?
A.
A?
Because the C0 is higher. So the present value is high.
So you now trying just to measure the distance, right?
Yeah.
Okay. Well, that might be an answer, but let's assume, I don't know. Okay, you're actually right if we measure the distance, but if we don't measure the distance, then I would say that portfolio D is the best one because you get positive amounts of money today, 1 year from now, and 2 years from now. So this is probably, the ideal case. And if I want to describe it like this, then I would say something like that. So now this is the negative price. So if you form a portfolio with a negative price, so you have cash right now, but at the same time, your future cash flows are strictly positive. So like that. So this is your portfolio D. You have positive cash flow right now, and you have positive cash flows in the future. So this is probably the best arbitrage portfolio ever. Okay, so now let me see how much time we have. So do I understand it correctly that we still have 9 minutes, about 9 minutes? So we were supposed to end up with at 20 minutes past 9, right?
Yes. I think so.
So we start at 8. So right, we start with 8, and then we need to finish at 9:20. So we still have 9 more minutes. So basically it means that we receive money right now. Yes, that's what I was saying. Up to now it is. So negative price. So that's what I gave you as an example. If you if your short position is larger than your long position, then you have a portfolio, right? You have a portfolio, but at the same time you have additional amounts of money. So now that's just the very important part. I'm afraid I won't be able to finish on time. There's one more slide which is left, but anyway, so let's at least finish this slide. So and this is just the right moments when you can switch on your abstract reasoning, which I was talking about, if you have any. So why do we need to switch on your abstract reasoning? Because right now we need to generalize. Generalize means that we move from the 3D space to the n-dimensional space. Why so? Because actually to the t-dimensional space. So why so? Because as I told previously, we assume that t is the number of periods left in the future, and we don't impose any restrictions on how many periods we have in the future. In this particular representation, we have only 2 periods in the future, simply because otherwise I would not be able to visualize this situation, because we can imagine only a 3-dimensional space. Tell me please if you can imagine a 4-dimensional space, but I guess no one can imagine a 4-dimensional space. But if we assume that t is simply the number of periods in the future, which is more than 2, then we cannot visualize, and now you can just try to imagine what is going on. So assume that we have a t-dimensional space, and each axis in this space represents one particular period, or actually it represents a cash flow received or paid in one particular period. So if this is the positive part of the axis, then that's going to be a positive cash flow. If it is the negative parts, like here, for example, then that will be negative cash flow. So here you receive cash flow, here you pay cash flow. And by the way, let's agree that actually these particular parts, the one which we have just considered, this is actually, if we're talking about a 3-dimensional space, then this is actually called a quadrant in Russian, или octant. I think it's actually octant. So this is called positive octants. In these positive octants, all axes are positive, so they have positive extension. And therefore, we can say that the whole this whole octants is actually a free lunch area. So because all portfolios, all points, which I can draw any points here, and all the points will have positive cash flows. Therefore, we can say that this is a strictly free lunch area. So any portfolio here is an arbitrage portfolio. Now, let's now look at the portfolio from other points of view. So let's assume that we try to describe the portfolio not from the points of view of how much cash flow you will get tomorrow, the day after tomorrow, 1 period from now, or just now. Let's describe a portfolio from another point of view, from how many coupon bonds you can put into your portfolio. And let's assume, for simplicity, as an example, so that you would understand it, let's assume that we have only 1 coupon bond. So n number of coupon bonds is equal to 1. So just simply 1 coupon bonds is traded in the markets. Tell me please, how many portfolios can we form if we have only 1 coupon bonds traded in the markets? So think of this. Okay, Zhao, you believe that's 1. So do you agree? What about the rest of the students? Do you agree that with 1 coupon bonds, we can form only 1 portfolio?
Actually, we can form how many portfolios as we want, but it will consist only of 1 bond.
Right, this is the correct answer. So in fact, you can form an infinitely many portfolios. It just depends on the weight which you attach to this portfolio. So for example, you can get zero weights. In this case, you will have a portfolio which is just empty. But from the theory, this is also a portfolio, empty portfolio. Now, you can get one coupon bonds, 1 unit of this coupon bonds in your portfolio. You can get 2 units of this coupon bonds, or if we move here beyond 0, you can get -1 coupon, and that will be short selling of 1 unit of coupon bonds, or you can get -10 units of coupon bonds. And therefore, essentially, we get infinitely many portfolios which form a one-dimensional space. So all these infinitely many portfolios lie along this one-dimensional space. Well, I hope you see that this is a one-dimensional space. Now, let's assume that we have 2 coupon bonds traded in the bonds markets. Now, tell me, please, how many portfolios can we form from the 2 coupon bonds? And what kind of space do we receive as a result? Right. So actually, we can write it like that. So again, if you put 0 weights to one portfolio, to the first coupon bonds and the second coupon bonds, you will be somewhere here. Here we have 0. But then here you use this axis represents the different quantities of coupon bonds 1, and then this axis will represent different quantities of coupon bonds 2. Again, for example, if you are here, then you short sell coupon bonds 2 and you do not have coupon bonds 1 in your portfolio at all. But if you are somewhere here, this is negative, right? This is negative, this is positive. And if you are somewhere here, then you essentially take a long position in coupon bonds 1 and the short position in coupon bonds 2. But anyway, you will get a 2-dimensional space. And when we increase n to actually n, so we have just n coupon bonds, then you can actually form an n-dimensional space which represents, and this n-dimensional space will represent all possible portfolios which you can form from the coupon bonds market. So all possible coupon bonds portfolio. So whatever you can compose, you can do this within this n-dimensional space. So let's see how much. Okay, we have only just 2 minutes, but this is probably the most important part. Now, we have 2 spaces essentially. So here we have, so this is t plus 1 dimensional space. Why I have t plus 1? Because recall that t is the number of periods left into the future, but we also have 1 axis left for now. So this is our axis which represents cash flow now. So therefore we need to add 1 more dimension. And now this is the n-dimensional space which represents portfolios from the points of view not from the point of view of cash flows, but from the point of view of how many coupon bonds we put into our portfolios. And now try to superimpose this n-dimensional space onto the t plus 1 n-dimensional space. Well, this is indeed where you can switch on abstract reasoning, because you cannot imagine this. But if you try, then you will see that essentially this n-dimensional space will become a subspace of t plus 1 dimensional space. Subspace because it has less dimensions, because we consider the case when n is less or equal to t. So therefore, we'll always have a kind of subspace, a linear subspace of this t plus 1 dimensional space. And now the only question is, if we try to superimpose this n-dimensional space into our t plus 1 dimensional space, then what will happen? How will these 2 spaces coincide or actually overlap? If it happens that the parts of this n-dimensional subspace occur in our positive octants, then it means that parts of our portfolios which we can actually trade in the markets are arbitrage portfolios. And then the question is only one: if it's possible that our n-dimensional space can somehow overlap with this positive octants, with this one. So this, let me just put it like that, with this positive octants. If this is so, then it seems that we do have arbitrage portfolios which are both arbitrage and at the same time they are real. We can construct them using coupon bonds portfolios. And so the only question which is left is if it is possible, if we can achieve this or we cannot. If we can achieve, then there is no price inconsistency, there are arbitrage opportunities, and if we cannot, even now, if we can prove that this is not possible, then we achieve price inconsistency and no arbitrage. So this is just this question. If this overlapping area is equal to 0, we have an empty set, or it has some real portfolios. So this is, I guess, will be the question for the next lecture, because we just don't have time right now. There is one more slide, but it's kind of, well, I cannot cover this slide within, I don't know, a couple of minutes. So I will leave the slides for the next lecture, which will be pretty much soon, by the way. And so now just what you should understand here is that we try now to, well, in the next lecture, we will try to show that this situation when feasible or real portfolios, which we can get from the markets, just will never coincide with this arbitrage area. So this is just not possible in theory. This is not possible in practice. So we're going to prove it next lecture. So tell me, please, that's it for today. And tell me, please, if you have any questions. I know that this is going to be difficult, but that's just something what I warned you in advance that this lecture is going to be difficult. So if you have any questions, you can ask. If it's something is unclear to you, I can try to explain once again. So looks like everything is clear. Well, indeed, this is true. So yes, I will send you lecture notes, and then I guess you probably need even to read it several times, not just even probably once, in order to. Okay, by the way, I can give you an idea. You cannot imagine that an n-dimensional space can be a linear subspace or vector subspace of T plus one dimensional space. However, you cannot imagine how they can be they can be superimposed one upon another. But let's just decrease the number of dimensions. Imagine that we have a two-dimensional space here. Actually, this is a two-dimensional space, right? A plane. So this is a plane. This is a two-dimensional space. And let's come back to this three-dimensional space. This is going to be, how do we call it? So this is a plane, and this is, so it's going to be like that, like that. So I need one more. No. So enough spaces, enough axes. So, and this is called actually, how do we call it? A cube, right? So this is a cube. So even though you cannot imagine without abstract reasoning how to superimpose an n-dimensional space into a T plus one dimensional space, you can actually imagine how to impose a plane into a cube. I think this will be easier for you. So tell me, please, can you imagine this? You take a plane and put it inside the cube. So do you imagine this? I think this is quite easily imaginable. No? Okay, so with the cube, it's easier. So once again, that's an example of abstract reasoning. In order for you to understand something, you need to have a good example, right? So I can also give you a good example with n-dimensional spaces, but probably with this reduced dimensions, you can imagine how to insert a plane into a cube, and then you can just see whether parts of this plane occur in this positive area or not. If they occur, parts of this plane, if this part of the plane overlaps with this positive area, then we have portfolio, which is first arbitrage portfolio, and then it is also a feasible portfolio in the sense that we can create it from the coupon bonds markets. Okay, that might help you a little bit. Anyway, you will have to read this lecture notes. So I'm going to send it to you, I think tomorrow, not today, but tomorrow. And we will finish. We finish today at these slides, and then we will continue with one more slide next lecture. So
I have a question. Sorry. What is a positive orthodoxy or positive metric? What is that? I don't get it.
So could you please say it again? You're asking about positive what?
Just in this C1, C2, C0, this axis, you mentioned it is a positive something. I don't get it.
Oh. Okay, I'm not sure whether you have it in your at your school mathematics, but well, you definitely let me just write it, draw it. This is something which we call the coordinate system. Do you know this?
Yeah.
System. So in this coordinate system, we have 4 quadrants. This is called in English. This is called quadrants. In Russian, we say. Oh, by the way, how do we say it in Russian? Четверть? Нет, не четверть. Guys, can you help me? How do we say it in Russian? Quadrants. Не квадрант же, да, как-то? И не четверть. Квадрант, да? Я что-то как-то засомневалась. Ну, хорошо. So, in English, we call it quadrants. So, each quarter of this plane are called quadrants. So, this is the first quadrant. This is the second quadrant. This is the third quadrant, and this is the fourth quadrant. And the only positive quadrants here is this one. This is also positive because it has positive values here, and it has positive values here. So this is the fully positive quadrants. This is for the 2-dimensional space. If we are talking the 3-dimensional space like that, then we actually call it octants, not quadrants, but octants. And this is going to be the first octants and the first, so this one. This is the first octants. Okay, just cannot, it's very inconvenient to write here. Octants. So, and these octants will also be positive because it's contains only extensions of this. So here we have only positive values. Here we also have only positive values. And here we also have only positive values. So this is the positive octants. And if we come back to our coupon bonds markets, then here we have only those portfolios which have positive cash flows today and in the future in arbitrage portfolio. So is it clear right now?
Yeah. So for 2 and 4 quadrant, it is a semi-positive quadrant.
Right. So tell me, please, for example, if I have a portfolio here, so this is my portfolio. Let's call me, I don't know, portfolio W. So how would you describe this portfolio from the point of view of future cash flow, future and current cash flow? So vertical axis is current cash flow, so C0, current cash flow, and this is our future cash flow. So we have only one axis, therefore we have only one period in the future. C1 is cash flow, one period from the future. So if we have a portfolio here, will it be an arbitrage portfolio?
No, because I pay money at this moment and get money in C1 in the future.
Yes, exactly. So indeed, you will get positive amounts of money in the future, but not right now your cash flow is negative. So you indeed give away money, and this is not an arbitrage situation. Actually, this is a normal situation. If you want to get, for example, dividends for the stock in the future, you need to pay money right now to buy this stock. If you want to get coupon payments from the bonds, you need to buy these bonds right now. So if we have this bond, if we have these points, then this is a normal non-arbitrage portfolio, the one which you would form under normal market conditions. So all arbitrage portfolios are located only in these positive quadrants.
Okay, thank you. Very clear.
Okay, good. So do we have any other questions? Okay, seems like not. Okay, so then let's finish here, and I think now probably it's a little bit easier for you to understand. Then you have some time to read lecture notes, and then I will explain the last very important slides for this lecture. So goodbye for now, and have a nice weekend. See you next week. Bye.